let's take a step back to interest rates. We're focused primarily on the impact of high interest rates on interest income from lending. What about government securities? We saw some banks increase the holdings of government securities, probably to hedge against deterioration in asset quality. The relationship between interest rates and bond pricing. We saw banks report huge revaluation losses. Maybe you can say something on that.
Yes, thank you, Ronaldo. So, actually, the only bank that had a revaluation gain was Stanchart, and this was a small, either 0.3 or 0.7% increase. So, yes, Equity Group is the outlier as at half year 2023 and has been since full year 2022 with revaluation losses of around 30 billion. I'm not sure about the figure exactly. And this is because they have huge exposure to Eurobond. And so at the end of the day, yes, these 8 banks will continue having revaluation losses. And this is because as interest rates continue rising, the value of your current bonds really goes down, so you get revaluation losses. And at the end of the day, also you will notice that even as there are banks like Stanchart, NCBA, ABSA, and IFM that declined their holdings of government securities, still the interest income of the same went up. But banks like KCB and Equity have strong growth in their holdings of government securities. So yes, in terms of revaluation losses, we'll still continue having that because of the rising interest rate environment, and also even if the banks would still decline their holdings, they'll still leverage on the margins because interest rates are quite high as it stands. We've also seen change in strategy by same Equity Bank. Now that you're talking about holdings of government securities, since actually September 2022 last year, they've been declining this metric, and it's only until half year of 2023 that they grew their loan book by around 17.9%. And so, yes, this speaks to the need to leverage on rising interest rates, and also since they're making a lot of money based on BCDC, you don't put all that into lending and risk asset quality performance. So yeah, I think that's what I can say.
Yeah, in terms of revaluation losses, Equity's loss was 38.9 billion shillings.
Yes, thank you.
I know Davis had talked about loan loss provisions. Maybe in greater detail, tell us how our expectations of loan loss provisions going now that we're in the second half of the year, and how we expect to close the year.
Yeah, so we expect loan loss provisions to go up quite a bit through the full year. So as you're seeing economically, we're not doing particularly well. A lot of industries are suffering, taxes are going up. So what that means is that a lot of businesses are unable to meet their loan obligations. And so banks preempting this, because they have constant conversations with clients, need to ramp up their level of provision. If I have to speak maybe to one bank like KCB, normally they provision on 2 levels. One level is IFRS provisions, so the accounting standards. The other is CBK provisions. Now, CBK provisions, historically, KCB has provisioned at around 70% of it. Right now, it's below that, should be around the 60s. And then on IFRS provisions, they normally average around 60%. Now it's at 50. And that's a common trend across all the banks. So banks need to really ramp up their level of provisioning to be in line with IFRS as well as CBK guidelines for full year. And so you'll see that as at ND, a lot of banks, or rather banks such as Corp Bank as well as NCBA, which as at half year had very, in my opinion, were quite under provisioned, they'll need to ramp up the level of provision, meaning profits are likely to be flat, at least on those 2 banks, the 2 big banks, Equity, KCB. KCB, the level of provision will need to ramp up just given how the asset quality is, and the issue, that adds up to their OPEX, operating expenses and the like. So both of them, I'd expect their profits to be flat. Equity, because of the subsidiary activities, profits are likely to go up double digits. Yeah, but across the board, you'll see differing results, but largely flat growth on the whole, just because of the level of provisioning banks need to take on to Q4 and going forward.
So in terms of value in banks, what are our expectations? Because yes, we've seen banks perform well financially, but the prices have fallen significantly. Our fair valuations show that there's a lot of room for growth in terms of private's performance, but the nature of our NSE continuous increase in foreign investor outflows means that prices might remain depressed for say in the near to medium term. What would be your advice to investors who are looking at banking stocks? Is there opportunity in banking stocks? So I've seen, for instance, an outlier in terms of NCBA returning 62% in the first half of the year. Do we see some value in investing in banks, at least in the near term?
So the best thing to do as an investor, we would strongly suggest that you buy stocks that will give you good dividends, like a good dividend yield. So stocks such as Absa, Stanchart, which give relatively good payouts, would be the most ideal within this environment, because you have to consider everything on the whole. So our stock market is largely driven by foreigners. Foreigners come, they trade actively, and that allows for price discovery. Locals or local institutional, your pension funds and the like, they just take the funds that they get, they invest for the really long term, so they don't actively trade. That doesn't create room for price discovery. By price discovery, I mean the share price reflecting the fundamental value of the company. So if you have an environment whereby interest rates are high globally, that means that for foreign investors it makes more sense to sell their shares and invest in other markets. So sell-offs will continue. For local investors, interest rates here are also high, meaning that it makes more sense to buy bonds rather than investing in the stock market. So you're likely going to just have a difficult, let's say, year and a half until at least 2025, if you look at how global interest rates are set to evolve. That means that the best thing is to buy dividend stocks that would enable you to at least get some returns, because time value of money is losing value over time. So they enable you to get some returns as the environment just continues being strained and difficult. So we would advise those dividend stocks, because the share price performance is likely to remain as is or even get much worse if interest rates just continue rising as they are. Yeah.
Staying with you, Davis, Diamond Trust, DTB. It appears significantly undervalued in terms of relative valuation. That's price to earnings and price to book.
Yeah.
But the price itself has been depressed for, let's say, even before for 4 to 5 years. What would you say about that stock? Do you see value going forward?
Yeah.
Or do you see better stocks or banking stocks that you'd rather invest in instead of DTB?
Okay, so with every investment decision, someone has to gauge the amount of return this investment decision is giving you. So for example, real estate might be giving you 6%, a bond maybe 10%, a stock is giving you this percent. And then now, those levels of return, or the reason why someone invests in that, is not only pegged on return, but also the risk involved. Now, for stocks, they have the highest level of risk, so people demand a higher return on stocks in order to invest in them. Now, a stock like DTB, unfortunately, the way that we measure returns on stocks is through the return on shareholders' equity. For DTB, the return on shareholders' equity from roughly 2020 or roughly 2019 has been below 10%. So that means that if you invest in this asset class, there was a time it was below inflation, below the company's cost of capital. The opportunity cost is so high that investors can't price this company similar to other companies, because if it has an ROE of 10%, other banks are doing 25-30%. So it's worth the risk to invest in these banks because of how high the return on shareholders' equity is, and the fact that, at least from a shareholder equity perspective, there are higher returns than other asset classes. But for DTB, it's just so low that the the level of risk outweighs the level of return. So that's why people discount it so much. And we attribute it to the fact that there could be better asset allocation. So the company is highly capitalized, they should reallocate their capital into other things, or give that money back to investors if they find no other thing to invest in. Yeah, so the share price would remain suppressed going forward unless the company, let's say, increases the payout policy to give more money to shareholders. I think that would be the main thing, to just reduce that level of overcapitalization.
So Isabel, we're looking at our banking recommendations based on the fair value estimates. We see all banks, with the exception of Standard Chartered and NCB as hold. What would be your favorite, or what would be your pick if you were to invest in any of these stocks, and why?
Okay, for me, as David said, I'd look at, in terms of short-term investment, dividend. So Stanchart has the highest dividend yield, or expected dividend yield, so I'd go for Stanchart. But for a long-term view, really most of our banks, even the KCB at 20, is a good buy in terms of a 5-year strategy, 10-year strategy, because fundamentals are quite strong. And so that means you'd be buying it at an affordable price right now. So I would buy KCB, Equity, NCBA as well, and Stanchart.
What about you, Davis? If you had to pick one stock or a few stocks from a few banking stocks?
Yeah, I think I'd say ABSA, because it's really well managed. They have a very good strategy, growing in double digits, to the extent that they're growing so fast that even their strategy to increase expenses, like they'll be unable to increase expenses at the pace that they're growing. So their strategy is to increase. They currently have a cost to income ratio. That's when you take your operating expenses and then look at operating income when you gauge the two. So theirs is the lowest in the industry at around, let's say, 37%. They want to get that to 45%, but that's not actually possible because of how fast they're growing. So they have so much room to increase their expenses, invest in a lot of things, but they're even unable to do so. That just testifies so much they're growing their operating income line. So I'd say that's the best. They have good margins, robust outlook, good leadership, and a good dividend. So I'd say that's, for me, the best.
And what stands out ABSA also is loan to deposit ratio of close to 100%.
Yeah.
So that's one unique thing about ABSA compared to the other banks.
Yeah.
For me, I would say it's ABSA as well because of the huge or the high dividend yield. As we conclude, last time we spoke about our weekend and the price increases or inflation. This week or on Saturday we saw another price increase in fuel. Another 5 shillings in terms of soup and about 4 shillings in terms of diesel. How do you think it's going to affect us going forward, or do you think we've already priced in these price increases in the cost of living, specifically transport, energy, food?
Yeah. Well, I'd say for transport, so earlier today, as I was coming here, I ended up paying, I think, 20 shillings more than I normally do. So it's already been priced in as far as transport is concerned. And then you're likely to see transportation costs overall go up. But the thing is that it might be offset a bit by the rains, just depending on the level of rains that we have. If we don't have El Nino, because flooding will destroy a large sort of crops. Yeah, so I'd say just the fact that oil prices are elevated and they may remain elevated at least through the end of the year, because we have a 2-month lag. Yeah, from next year they'll likely come down because oil prices right now are almost at around $60 a barrel globally. They've really been coming down. Yeah, but for us, at least for the very short term, till the end of the year, it will likely affect everything across the board. Yeah, but not as materially as it did before, we put it like that, because people have really adjusted to these shocks, if you will. That's my view.
Isabel, what's your view?
Yeah, I think at the moment we're sort of expecting we're sort of living in a way that we're expecting prices to keep rising all the time. So we're ready to adjust should prices continue rising, and every business is on toes. They keep adjusting the prices upon this information. So really, I don't have much to say against what David said.
So Isabel says we're ready to adjust. I feel that we have no choice but to adjust. Any other thoughts on the direction the economy is taking? I know top of our head is high cost of living. Second, probably the cost of debt or the huge growth in public debt.
Yeah, things are not ideal. They should really start reducing recurrent expenditure, because that's the only way. The only way we'll sustainably get out of the problems that we're in. Like, can't peg it all on revenues. Revenues through September, I believe, from what's come out recently. So going forward, I really believe they should reduce recurrent expenditure, because that's the only way to sustainably get out of the hole that we find ourselves in. We can't peg everything on revenues. Revenues are underperforming, and with the strain on businesses, as evidenced by the high NPLs, you see that revenues will continue underperforming the targets, because the targets are so high. So the best thing is to reduce recurrent expenditure and reduce all that waste, reduce corruption, and hopefully we'll be able to sustainably grow going forward. The Eurobond maturity that's coming up, you have so much support from the IMF and the likes, who are likely to pay that, or rather refinance that. But otherwise it's a difficult environment. I feel for the many businesses all around that are hurting under this current macro environment, and we just pray that things improve, or rather the government sees that everything can't be pegged on revenue, pegged at least on reducing expenditure.
You have mentioned reducing recurrent expenditure. A big portion of recurrent expenditure is interest on debt or debt repayment. So it might not be as easy as it sounds, because a big proportion of our income goes to settling debt. Isabel, any thoughts as we close?
Yes, as we had said in the previous video, in terms of settling our debt, yes, IMF is confident that we're going to be able to settle our $2 billion USD Eurobond to mature next year. And so at the end of the day, really, we just need to be more careful in terms of how much debt we take up. The $2 billion really was quite huge. We should be taking up debt in chunks to help us pay back with ease. And also, we have, I keep forgetting this thing. It's called syndicated loan. Yes, we already have syndicated loans from different players across board. So yes, we are going to be able to pay, or I believe we'll be able to pay this debt. But moving forward, we need to be self-sustaining as a company. As a country. That is, we take advantage of agriculture, which is our strong point. We try boost manufacturing by having levies and not removing levies, etc. And so sort of try and reduce the uptake of external debt in dollars or in external currencies. So that's what I would say.
So when we took up the Eurobond, the 2 billion Eurobond in 10 years ago, close to 10 years ago in 2014, it was about, say, 180 billion shillings. At today's exchange rate, 300 billion shillings. So you can see the magnitude, it's grown just by the depreciation of the shilling. So I guess that concludes our discussion. For those watching us, don't forget to subscribe to our YouTube channel. See you in the next episode.
Bye.
Bye. Bye.